What's going on, guys? My name is Matt. This is Run Up the Score, and today we are embarking on a long journey together. I'm really excited about it. I've been thinking for a while about what I wanted to share on the channel and just how I wanted to format it. And I've come to the conclusion that I'm going to be doing two portfolios. One is my personal, just exactly what I'm doing, just to share and kick around ideas and stuff. And the second one is one that I'm going to be doing for my kids. And it's a completely different style of portfolio, and that's the one that I'm going to be sharing with you today. It's not actually sharing the portfolio, it's just sharing the, parameters and what it's going to be. So we're going to be slowly adding to it and building it over time. I'm going to set up the rules towards the end of this video, but to start, I want to go over this paper, which totally lays out the investment case for this type of portfolio. Now, it is called a coffee can portfolio, and you guys may have heard of this. Some people will also just call it a never sell, buy and hold strategy. Buy and hold, I think, sort of implies a sell at some point. Coffee can portfolio is just literally never sell. Selling is not an action you can take. It's a one action portfolio. It's only buy, put it on a shelf, and it got the name, which I'll go into here. I actually wanted to look at, okay, so this paper was written in 1984, fall of 1984. And a lot of people seem to have the mindset of 1984, that's ancient history. None of that stuff really applies anymore. It's a new world, new paradigm. I think the factors that are active in financial markets are pretty consistent across time. Certain things get amplified maybe, and there's obviously technology involved these days. But the general principles of supply and demand, buyers and sellers, it's all across space and time, it's kind of the same thing. So no matter how old the paper or the information is, I think you can still learn something from it. And this paper, I think, is incredibly impactful even today. So it's called the Coffee Can Portfolio. Now, I don't really know too much about the author. All I know is that he's an investment advisor, a money manager of some sort. And I have a few parts here highlighted I just want to go over to kind of lay out the case for why I'm doing this portfolio and why I think it's perfect for setting up your kids. So I have two kids. One of them is 7 months old. One of them is 2 years and 7 months old. So, by the time they're 20, 30, hopefully this will be multiplied a substantial amount. The basic idea for the start of the paper is talking about passive indexing, which is buying index funds, which is very popular these days. Most people, passive investors, they just buy index funds like SPY, VOO, VT. There's all these different index funds. And the question is, why index and why not? So in my opinion, you have two alternatives. This is a direct quote from the author. Which you choose depends on your reasons for pursuing an index fund to begin with. Do you believe that the market is efficient and you want to adopt a program that replicates the market because that's the best you can do? Or do you believe that traditional active portfolio management incurs such high transaction costs that even the best money managers are unlikely to produce superior investment returns consistently? These are two different reasons. This is definitely a good question to ask yourself, and I think the basis of the question is do you think certain people can outperform the market? And of course, I am a big believer that they can. Warren Buffett, 65 years he's been doing it, right? So there's obviously certain people that can outperform the market. I'm not a big believer in the efficient market hypothesis where every piece of information is perfectly priced. There's no way you could possibly have an advantage. So I would say definitely I fall into number 2 here, the second option. And then here's an interesting section. When is active passive? And then there's a follow-up section, which is when is passive active? So active investing, if you guys don't know, it basically means either you're a personal investor or you have a money manager who is actively investing, choosing stocks, basically stock picking. The coffee can portfolio concept harkens back to the Old West, when people put their valuable possessions in a coffee can and kept it under the mattress. The coffee can involved no transaction costs, administrative costs, or any other costs. So a big part of the coffee can approach is minimizing costs, transaction costs, frictional costs. The success of the program depended entirely on the wisdom and foresight used to select the objects to be placed in the coffee can to begin with. So this sort of frames everything in what I think is a really insightful and constructive way, which is that when you're eliminating one of the decisions, which is selling, there's a lot more emphasis placed on the buying. You're stuck with this thing forever. So you're really focusing on is this a good thing? Do I want to buy it? A lot of thought goes into it. It's not just like, oh, I heard a tip on CNBC that this is an up and coming company. You really place a lot more importance and emphasis on the buying because there is no other thing. There's no selling. So another thing it does, which hasn't really been referenced yet, is you're thinking a lot about the terminal value and the long term, what this business looks like in a terminal state. So like Coca-Cola right now is in a terminal state. They're just like growing very slowly. I don't even know if they're still growing. They're always going to be around. They're a company that has a pretty high terminal value. So something that maybe the terminal value is more questionable would be like TikTok, like the social media app. Like, what does TikTok look like in 30 years? Are people still going to be watching 15-second videos on their phones? They could be. It's a lot more up in the air and sort of unknown. So the terminal value of TikTok is a lot more questionable than something that's more stable like Coca-Cola. So it puts you a little bit more in that mindset, thinking about really long term, what's the company going to look like, 50 years in the future. So now talking about an alternative to indexing. I suggest that you find the best investment research organization you can and ask them to select a diversified portfolio of stocks with the knowledge that the portfolio will not be reevaluated or re-examined for a period of at least 10 years. So he's advising maybe don't even do the stock picking yourself. Find an investment advisor. I think following super investors is a really good substitution for this, which is why I track a lot of the super investors and what they're doing with their portfolios. What kind of result would good money managers produce without all that activity? The answer lies in another question. Are we traders or are we really investors? Most good money managers are probably investors deep down inside, but the quotrons and news services and computers that churn out daily investment results make them act like traders. They start with sound research that identifies attractive companies and promising industries on a longer-term time horizon. Then they trade these stocks 2 or 3 times a year based on month-to-month news, developments, and rumors of all shapes and sizes. So he's writing in 1984, when the average holding time of a stock was still over a year for average people. And I think the average holding time today is like a month or something like that. I have to look up these numbers again. But he's identifying a problem 40 years ago that's only gotten exponentially worse today. And from everything I've read and learning from sort of the best investors of all time, what it seems like the number one advantage people like me and you can have is long-term time horizon, low activity, and just disconnecting from CNBC and all these different people trying to get you to transact and trade a lot. The number one advantage you can have is buying and holding great businesses for really long periods of time. Take the example of constructing a new common stock portfolio of $100 million. The average orthodox professional money manager would build a portfolio something like 50 $2 million commitments. So 50 stocks, $2 million each representing 2% of the fund. If that portfolio were then buried and forgotten for a while, several obvious conditions would apply. First, the most that could be lost in any one holding would be 2%. And the second, the most that the portfolio could gain from any one holding would be unlimited. After all, there would be no one to apply the concepts of diversification and too much exposure to a given company or a given industry. So this is another pretty important concept that is tough to do, and it's letting your winners ride, because at least for me, everyone has their different biases and like different mistakes they make just psychologically. So for me, like letting my winners ride really far is tough. Like it's fun to lock in a profit and it makes you feel good that you made a smart decision, you made a good investment, and to lock in some of the profits, because who knows what happens in the future. You don't want, it's tough to see your investment go up 200% and then go all the way down so that you're down on the position. That's really tough to handle emotionally. If you do this type of approach, it makes it a lot easier to handle that. So there's no like trimming positions. There's no worrying about being diversified or too concentrated. Theoretically, one of your positions could end up being 90+% of your portfolio, or even like 99%. So that is something to be aware of. This really just makes all of the errors of human behavior a lot easier to manage. So this next passage is an amazing example of this in action. So the potential impact of this process was brought home to me dramatically as a result of an experience with one woman client. Her husband, a lawyer, handled her financial affairs, and he was our primary contact. I had worked with the client for about 10 years when her husband suddenly died. She inherited his estate and called us to say that she would be adding his securities to the portfolio under our management. When we received the list of assets, I was amused to find that he had secretly been piggybacking our recommendations for his wife's portfolio. Then when I looked at the total value of the estate, I was also shocked. The husband had applied a small twist of his own to our advice. He paid no attention whatsoever to the sale recommendations. He simply put about $5,000 in every purchase recommendation. Then he would toss a certificate in his safe deposit box and forget it. Needless to say, he had an odd-looking portfolio. He owned a number of small holdings with values of less than $2,000. He had several large holdings with values in excess of $100,000. And there was one jumbo holding worth over $800,000 that exceeded the total value of his wife's portfolio and came from a small commitment in a company called Haloid. This later turned out to be a zillion shares of Xerox. Some exaggeration in the total amount of shares there. But yeah, that's sort of what happens. And actually the other day I was asking my grandma, who's been investing in the stock market for, I guess, like 70 years now. And she has always stressed to me buy and hold. But even her, I was like, what's your oldest stock that you currently hold? And she said it was AT&T. She bought it in like 1962 or something. But she said that was really like the only one she's held throughout. A lot of them she's traded more often. But she probably holds every stock for at least like 10 or 20 years. But yeah, it's cool. Like, it's almost like a point of pride to say like, yeah, I still have this stock from 1961. So that is the setup. That is the strategy, the coffee can portfolio. You buy, you never sell, and over time you end up with vast fortunes. That's sort of the way it should work. Obviously, the stock selection and the long-term time horizon is a big component of this. So the way that we're going to do this portfolio for the channel, and we're going to track it, is every 2 months, I'm going to have $1,000 to spend. So it doesn't necessarily mean that I have to add a new position every 2 months, but the money will accumulate and I can add to it at my convenience or when I see a good opportunity. So we're going to be having 6 new positions per year. So the rules are you can only buy a stock one time. You can't say, oh, it's a really good deal, I'm going to buy more of it. You just buy it one time, you put it away forever. You spend the same amount of money on each position, so it's going to be $1,000 plus or minus maybe, $50 to $100, just depending on how it works out. So if it's a $300 stock, maybe I'll buy 4 shares of it or something like that. So it could be a little bit more, but essentially $1,000 each. So that'll be 6 new companies per year. There's 3 major types of businesses I'm looking to add to the coffee can portfolio. There is the compounders, which is like, you can think of Amazon, Apple. They just compound at really high rates over time. They have really good reinvestment opportunity, and they're likely to continue to grow for a very long time. So that's one definite type of company we're looking for. Number 2 is going to be the spawners, which is, I think, the companies I'm most likely to put into this portfolio. These are companies that create businesses within their current business. You can kind of think of Amazon as one of these also, like they created Amazon Web Services. They created Prime Video. So while their major business is e-commerce, and that's still kind of what they're known for, in a distant future, maybe e-commerce goes away. They're not tied to that. Like, they're likely to pivot and have new lines of businesses that come online. So the terminal value risk is not as high, even though you might think like they're a tech company, there's going to be innovation that sort of knocks them and starts competing with them. They have a company culture where they're likely to just keep on compounding over time. And a lot of the companies we're talking about are like in multiple categories here. And then the last type of company is just a very durable business and a extremely high competitive advantage. Coca-Cola is a good example of this. Basically, the business is extremely durable. We're always going to need drinks. They have a really strong competitive advantage, the Coca-Cola brand, the distribution, worldwide distribution. So that would be an example of a company that could go in the portfolio as well. And one last thing, to jumpstart the portfolio, just so that we have something to track and we can kind of see the progress so it's not kind of boring like we start with one stock, I'm going to start with 5 companies in the portfolio to begin with, and I will have videos on each of those coming up soon. That's going to do it for this video though, guys. We're going to be tracking the coffee can portfolio, hopefully for years to come. Comment down below. Let me know what you think. Let me know what kind of companies you think would go well in this sort of a portfolio. And thanks for watching.